understanding all the options available in the CARES Act and making sense of the best choices for you can be a huge headache. For one thing, you have to spend countless hours reading through articles and searching for explanations, or nag your colleagues and hope they got the right answers. You also have to calculate the break-even on employee layoffs compared to SBA loan forgiveness compared with long-term economic stability for your practice. Plus, there's the challenge of guessing at whether the interpretations of these new laws might change in a week and completely derail your strategy. As a result, managing your financial well-being and the cash flow in your practice during this uncertain period is a more time-consuming and all-encompassing hassle than you ever bargained for. Fortunately, there's a better way. Introducing Moss, Luse & Womble, a one-stop financial planning and accounting firm that specializes in the unique needs of dental professionals, so you can relax, knowing you've left the complexity of analyzing all your options to the experts. With Moss, Luse & Womble, we allocate appropriate resources to provide accurate and vetted information to all our clients and their colleagues that can be trusted. Then, we speak with our clients to help them understand their individual situations and customize a plan. And when these more immediate concerns wane, we'll spend a full day learning about you and your goals. In addition to being the foundation of your step-by-step financial plan, this in-depth consultation will also serve as an integral part of the process every year going forward. And of course, you can also trust in our commitment to personalized service, like speaking directly with a member of our team via email or phone whenever you have questions or need advice. One of the smartest ways to ensure the health of your practice is to put sensible routines into place. Our accounting, tax, and payroll services are designed to help you keep your finances in the best shape for the long term. But perhaps the best thing of all is that our services are designed with efficiency in mind. We integrate those tax and accounting compliance services with our tailored personal and business financial planning advice. This often saves you time and money. To learn how MLW can provide vital solutions and expertise you need to achieve a sense of balance, direction, and peace of mind during these turbulent times, review our website at mlwfinancial.com or call our office to schedule an introductory meeting at 972-674-2584.
Good evening, everyone, and welcome to another installment in our MLW webinar series involving all the issues related to the effects of this pandemic on your practices and financial lives. My name is Jeff Moss, and we are again live from our socially distanced MLW office here in Addison, Texas, where we are continuing to watch the twists and turns of the ever-changing payroll protection program. Just when we think we've got most of the information needed to optimize a strategy using this loan program, the SBA or Congress changed the rules yet again. This evening, we will introduce you to the latest chapter in the PPP loan saga, the recent passing and signing into law of H.R. 7010, the PPP Flexibility Act. Now, the good news is that the bill makes loan forgiveness simpler and more straightforward, as we will describe soon enough. But before you celebrate, prepare for those favorite 4 words that you've become so accustomed to hearing. We're waiting for guidance. As you might have guessed, not all questions have been answered just yet. This evening, we will also bring you some extremely important information regarding the use of EIDL proceeds and how to stay in compliance with required loan provisions. And then finally, we'll take a first look at the proposed HEROES Act, a 4th stimulus package currently being considered by Congress. Our panelists this evening will be MLW partners Jason Luse and Michael Womble and senior planner Miles Kellum. They will be informing you on their given topics and answering your questions live. Speaking of which, if you have questions for us, please use the Q&A feature located in the application. We will answer the most commonly asked questions live, and we will also have a separate off-air panel that will be responding to some of your questions via that Q&A function. And as a reminder, we won't be using the chat feature. So with our main topic involving the Payroll Protection Program Flexibility Act, we'll get started with Miles Kellum. Miles.
Good evening. Tonight I want to begin our discussion about changes to the PPP loan program by looking back at a timeline of where we've been.
So I think we all know this has been a long and winding road
for the PPP journey that we've all been on. And so I wanted to review a timeline of events, beginning with the start. On March 25th, Congress passed the CARES Act. On the 27th of March, it was passed into law. Certainly a lot of chaos, a lot of uncertainty going around our country at that time. And then on March 31st, we got our first bit of guidance when the SBA released a one-page kind of general guidance update on PPP loans. And it was around that time that we really got kicked into high gear because the Treasury and SBA announced that they were moving up the timeline for the launch of these loans, and we're going to begin the program on April 3rd with it going live. So on April 2nd, we got some additional information as things went into high gear, getting ready for that release. The SBA released their interim final rule number 1, a name that still short circuits my brain in a lot of ways. And after that, they released the final version of the PPP application, only to a few hours later immediately update that final application with a new version, which happened to come right in the middle of an MLW webinar when we were live with all of you. And boy, that was a fun night dealing with that behind the scenes. The next day, sure enough, on April 3rd, we did go live with that PPP funding round 1. About halfway through the day, the SBA released a third version of its final application. Yes, after banks were already starting lending to applicants that had used an old version of the application. And then they did release their first round of FAQs with some updates and a new interim final rule number 2 that immediately replaced the final rule from the day before with some technical corrections and other updates. After that, we had several more updates in April. We had FAQ updates 2, 3, 4, 5, and 6 on April 16th. Along that time, PPP Round 1 officially ran out of funds. That caused a lot of angst and frustration for many of you listening tonight. And then between then and the end of April, we got more FAQ updates, 7, 8, 9, 10, 11, 12, 13. Some of these were minor, but some of these had pretty major updates along the way as to how this program was going to be run. You got the sense that they were still bolting on the wings of this airplane while we were taking off from the runway. Then on April 24th, the PPP Round 2 funding was signed into law. That reactivated the current round of funding, which is still live, and many of you were able to get loans who might have missed out on the first round. In early May, we got additional FAQ updates, 14, 15, 16, and 17, expanding that frequently asked questions page. And then on May 8th, they released a new interim final rule. That was the third one that would apply to our clients. That was for the safe harbor need-based request. I think in late April, there was some alarmist news that came out that had many people feeling like they might be going to jail simply for accepting a PPP loan if they somehow hadn't in good faith exhausted every possible option of other financing. And so the SBA came out with that release saying if your loan was under $2 million, you were not subject to those requirements. And then on May 15th, we thought, here we go. The SBA released their final PPP forgiveness application. And we were ready to go forward with the webinar. We thought, all right, we've got the information we need. Here's how the forgiveness is going to work. Let's go live with this. And almost immediately, we heard inklings that there was going to be another update coming out. We rescheduled our webinar. And sure enough, a few days later on May 22nd, the SBA released IFR number 4, which had a lot of updates, a lot of additional insights, clarifications, rule changes to how they were going to enforce that loan forgiveness application. And right around the time we were ready to go live with that webinar, after the new IFR, we started hearing rumors out of Washington that, sure enough, Congress was intending to pass an amendment bill for the PPP program that would allow for more flexible repayment terms. And sure enough, on May 28th, the Paycheck Protection Program Flexibility Act passed the House. On June 3rd, it passed the Senate, and last week on June 5th, it was signed into law by the President. It's been a long process. It's been a lot of changes along the way, and one thing that stands out is the use of the term final across the board here in terms of how these things were labeled. It's a little bit interesting. It appears that final may not quite mean what it used to mean anymore, because even that final PPP forgiveness application is going to have to be redone now that we've amended the law here. And overall, as we look back at this timeline, I want to give us space tonight to express some frustration over the way our country has rolled out this program. I do think this was a good program. It was intended to be a social safety net, to be an economic safety net for small businesses that in many ways are the backbone of our economy. And it was intended to get this funding out. But I think each of you listening tonight have a right to be frustrated that you received money perhaps at somewhere along flag 5 or 6 or 7, and then played the game to the best that you could based on the rules that were available at that time, meaning you worked with the staff to bring them back off unemployment, thinking you needed to restore them as quickly as possible in April or early May. You might have guaranteed hours even when your office was only partially open, or paid out overtime to staff trying to maximize your forgiveness from this program, only to get halfway, 2/3, 75, 80% of the way and find out that Congress is changing the rules of the game on you. And that is very frustrating. I think we have a right to be frustrated about that. At every point, we certainly have tried to give you advice that made sense based on the rules that were in place along the way. And as those rules have changed, we've updated our guidance accordingly. And based on this most recent act that was signed amending it, that guidance has really changed quite a bit. And so let's jump into some of the major aspects of those rule changes. One of the major provisions of the new amended program is the expansion of the original 8-week covered period for loan forgiveness to a broader 24-week covered period. Now, it's not yet clear exactly how you're going to make that election to choose the 24-week covered period. Presumably, there's going to be a rewrite of the SBA's, final loan forgiveness application that is now outdated. And so they're going to need to be updating that. My guess is there will probably be an election on there. We won't get too hung up on the details tonight, but let's assume that everyone will qualify for that election to do a 24-week covered period. And broadly speaking, I think that's good news for virtually everyone listening tonight. What it really comes down to is that you're going to have roughly 6 months to spend a loan that was based on 2.5 months worth of payroll. So pretty much everyone listening tonight is going to most likely spend many times the amount of loan proceeds that they received in qualifying expenditures, 2 or 3 or 4 times as much. So we should have a much more direct, much more simplified way of accessing full forgiveness on these loans. And overall, like we were saying on the previous slide, I think there's reasons to be frustrated about this program and the way it's been rolled out and the way it started. This amendment, in my opinion, does get us to the place that it should have been from the start, which is a very flexible, very open-based loan that will allow you to reopen your business, run it on the terms that you would otherwise run it, meaning bringing staff back when you need them back, working the hours that your office is open, paying your rent and utilities as they come due, just doing everything like normal as you are trying to reopen your business. And now that PPP loan and the use of those funds is going to fit a lot more seamlessly into that timeline of reopening your business. And so I do think this part is good news. They really have improved this program overall. So that covered period window is extended from June 30th to December 31st. And what I mean by that is there was language in the original CARES Act that said that used the date June 30th, whether it was the cutoff for new loans or this safe harbor date for when employee numbers had to be restored and things like that. That date has been struck from the record in the CARES Act, and it's been modified to say December 31st, 2020, which brings it in line with this new 6-month covered period that these loans are going to have. So we've got flexibility there, and that would potentially allow businesses to wait all the way until December 31st at the end of the year to fully restore employment levels. So maybe your 6-month window ends on October 15th. You could restore by then and apply directly there, or also if you're still not fully recovered, you could wait as late as December 31st and make sure to restore your employees by the end of the year and still potentially get full credit for loan forgiveness. And that does apply, by the way, to all PPP costs, both payroll and non-payroll. So don't worry too much about the allocation between the two. I think, like I said before, you're going to end up spending 2, 3, 4 times the amount of qualified costs that you would need to get full loan forgiveness. So whether it's your June and July and August payroll or your September rent, overall, I don't think you have to worry too much about which expenses are going where, as long as you spend the amount that's in your PPP loan during that window of time. To a degree, the allocations will take care of themselves. Now, with that being said, there are a couple of broad restrictions on how the money must be allocated, and some of that was modified in this amendment. One of which was the old requirement that 75% of forgivable expenses must be used toward payroll. That has been changed such that now the new requirement is that 60% of the loan amount must be spent on payroll expenses. Now, let's take note of the subtle difference in wording, which does create a potential cliff here. Under the old one, to give an example, if you got a $100,000 PPP loan, but you only spent $50,000 on payroll, that wasn't necessarily a problem. You could still get not full loan forgiveness, but you could still get loan forgiveness on the money that you did spend. What you would do is you would take $50,000, you would divide it by 0.75, that would gross up and give you the full amount that you could receive forgiveness for. It would be less than $100,000, but you would get your forgiveness pool, and that's how you would calculate that. This new requirement says that 60% of the loan must be spent on payroll. So if you got a $100,000 loan, you only spent $50,000 on payroll. Technically speaking, it appears right now you would get zero forgiveness because you did not spend 50% or 60%, of the loan amount on payroll. That has been subject to some debate in Congress. Certainly Marco Rubio has been pretty vocal in saying he's hoping to get that fixed in technical corrections for the bill, that it was not the intent to create a cliff like that, where if you spend 59%, you get zero forgiveness. If you spend 60%, you could possibly get full forgiveness. So we'll see if there are any updates that come out of that. That being the case, I wanted to include this anecdote because you may be reading this online, your buddies forwarding you newsletters about it, whatever the case is. So I wanted to discuss it tonight. I really don't think it's going to affect hardly anyone from the majority of our listeners tonight, because again, like we said previously, you're going to spend 2, 3, 4 times the amount on payroll and rent and everything else that you would need for this loan. So you could probably well and easily clear that 60% hurdle on payroll expenses. I think the only people this might affect would be our single employee LLCs, maybe in like a shell corporation, or if you're an independent contractor that had set up an LLC to receive your 1099 income, something like that. We may have to take that one on a case-by-case basis. So if you're in that situation, I would definitely encourage you to reach out to your planning team and let them work with you on a game plan for how to handle that. But for the vast majority of you that are sort of a typical setup with employees and doctor all paid out of the same entity, for you should pretty easily clear that 60% hurdle. And then really the question of the hour, I've gotten this question numerous times over the course of the weekend, is whether the owner-employee compensation limitations or compensation limitations for any business owners have been expanded by the provision. And where that's coming from, the CARES Act itself specifies that $100,000 is the cap for salary, for annualized salary for any employee, including a business owner. And on top of that, in some of their interim final rule updates, the SBA expanded upon that and said that the definition for the 8-week window was 8 50-seconds, meaning 8 out of 52 weeks in a year, multiplied by that $100,000 annual salary. That's where that $15,385 compensation limit comes from that you've probably seen used by our webinars and other online articles and things like that. There's a lot of debate now whether that 850 seconds limitation should be expanded instead to 2450 seconds in recognition of this new 24-week forgiveness period or covered period for the loan. Overall, I'm not sure if that was or was not within the intent of what they were trying to accomplish. Certainly that $100,000 compensation limit, that section of the CARES Act was not amended or modified. So the original definition hasn't changed. And it's going to be up to the SBA to see if they come out with additional guidance as to how they're going to enforce that 8 out of 52 compensation limit. Really, the intent of this amendment was to funnel additional money and payroll towards the quote-unquote rank and file employees, those hourly wage earners that are non-business owners and being paid out of the practice there. And so whether they expand the business owner compensation limits remains to be seen. An early Forbes article that came out over the weekend on this said, until further guidance, assume that compensation limit remains $15,385. And I would generally tend to agree with that sentiment. I think that let's plan for that number unless we see an update that comes out down the line. Which, by the way, to be clear, that $15,385 is the maximum that could be included, not a guarantee. So if you were maybe in a smaller practice or a startup that was growing or something like that, and you paid yourself a salary less than $100,000, your owner comp was less than $100,000 in 2019, you have to take, whether it was $80,000 or $60,000, you have to take 850 seconds of that lesser compensation amount, and that is your limit. So in that case, your limit would not be as high as $15,385 that you could have forgiven. It would be a lower number. So just a heads up there on the owner compensation. Again, if you've got staff in your office, we should be able to fully utilize this loan on other expenditures. We can put you back on your normal salary or whatever salary your office would support. But as of right now, that does appear to be the cap that we could include for any business owner. Next, we have a couple of new exceptions to the full-time equivalent employee requirements. And again, this is that one where you're looking at total hours worked by staff in your office divided by a base of 40 hours. Gives you a FTE number, full-time equivalent number of 0.4 or 0.9. If they work 40 hours a week, they count as a full 1. They can't go beyond 1. And you're adding all of that up. So we're looking broadly at the total hours worked by your staff. And yes, if you hire a new staff member, if you're adding staff, maybe because your business is really busy coming back from the shutdown, you can get credit for those new employees as well. But if that total FTE number is below where it was either in early 2020 or in the first half of 2019, potentially you could have your loan forgiveness reduced. But they've added a number of exceptions to that requirement, whether it's just offering a job to an employee who can't come back or will only accept reduced hours because of concerns of childcare or coronavirus exposure or whatever the case might be. But in addition to that, this amendment did add 2 new exceptions. The first is available to a business if you let an employee go during the quarantine and then you attempted to rehire them and they did not want to come back. And because they didn't want to come back, you started looking at other employees out there that you could hire to add and fill that position, and you can't find anyone to fill that position. Then you can document that and get an exception to the FTE requirements for that position. Hopefully this is something that is going to resolve itself later on as the unemployment, supercharged unemployment does expire on July 31st. At least it's set to right now, assuming it doesn't get extended. We'll talk about that later tonight. But it makes me think of right now the current labor pool for RDAs and RDHs as a potential example. I know some of you may have lost an assistant or a hygienist for one reason or another during this time, and you would like to rehire someone else, to hire someone else to fill that position, And because people would rather perhaps stay at home to collect that unemployment instead, or just are concerned about returning to the workforce right now, it's been hard, especially for my clients in bigger cities, to find someone to fill some of these positions. And they may have ended up going through just an ongoing string of temporary workers and fill-ins to try and cover that position with a temp agency. So hopefully that resolves itself before the end of the year and you're back to full employment anyway, and it's not a big deal. But if that were to continue, through the end of the year, through the end of your covered period, you could potentially claim an exception for that and not be penalized because you couldn't find someone that was qualified to take that position. The second exception is if you can document an inability to return to the same level of activity that you were at prior to the coronavirus pandemic. And if that reduction was due to compliance with requirements established by government bodies like Health and Human Services, CDC, or OSHA that were related to COVID-19. So if you are concerned about being in a position where your business is only 80% at capacity of where it was before, or 70%, or whatever the case might be, and you feel like that may stretch on into the fall through the end of the year, potentially you could get another exception if you are offering your employees their same position, but you can only offer them 80% of the hours that they had before, 70% of the hours that they had before. You may still qualify for full forgiveness of the PPP loan if that reduction in business was due to governmental requirements for your operation of your business. That was what was restricting you. So there are several broad exceptions there. Overall, this is good news. I've seen some concern about how much you have to maintain. Like, do I have to maintain my FTEs for the whole 6 months now? What if I have fluctuations in my business, things like that. Again, hopefully businesses are reopening, we're getting back to work, our economy is getting back online, and you're getting just organically closer and closer to full employment from where you were before. But even if that's not the case, there are now a number of exceptions that should qualify for a reduction in those requirements that you could still get full forgiveness. So again, should be very, very broad amounts of full forgiveness of these PPP loans.
So we've had a few questions about how do I document, what do I need to do if I've got an employee that turns down a job offer to come back to work for me. And in their most recent, again, May 22nd, interim final rule, the SBA did provide some additional clarification for this. And they came out with a 5-part test that must be met to confirm an excludable reduction in the FTE number. And quickly, those 5 pieces are: first, you must make a good faith written offer to rehire that employee during your covered period. Was 8 weeks, now it's 24 weeks. That offer needs to be for the same salary or wage that the employee had before, the same number of hours as earned on the last pay period before they had a separation from the company or a reduction in hours. So you've got to have a good faith offer that we're going to get you back to where we were before. And that offer has to be rejected by the employee. So you need a documentation that employee, some kind of written or screenshot of documentation that employee rejected the offer. And then you need to maintain records of that documentation in your files and that the employee rejected it. Now, with that loan application, they did say that this is not part of the documentation that's required to be submitted to the bank for forgiveness, just that you need documentation supporting that you offered them the job and they turned you down, that would be available upon request. So save that in your files, hang on to it there. And this 5th one is new for many of you, so I wanted to go over this tonight. They also included a requirement that the borrower, the employer, must inform the applicable state unemployment insurance office of such a rejected offer of reemployment within 30 days of the employee rejecting that offer. Now, I know several of you are already thinking, okay, well, 45 or 60 days ago, this employee turned me down and I didn't know I was supposed to do this. I think we're going to see some grace given here early on, so don't worry about that 30 days too much. But let's talk about how you can submit to a state unemployment insurance, how to inform them that the employee has turned down their job offer. So most state unemployment agencies are launching websites where you can report these employees who have turned down a legitimate offer of reemployment. And again, this is part of the government's move and to establish a program that will allow them to track people that may be abusing the supercharged unemployment, that may be intentionally not accepting work because they'd rather stay at home and collect that supercharged unemployment. And so they are trying to build a framework as to how they can get things back on track in the labor pool. No matter what state you're in, the easiest way to find your state's program, if one's been created, again, most states, I saw probably 10 or 12 as we were researching leading up to this. I think most have done it at this point. You can check on the Department of Labor's website, Career One Stop, which has a lot of nationwide resources for all 50 states and their unemployment agencies. And so if you follow this URL that we've got on the slide tonight, that will take you to their program where you can search by state to find the individual resources that are available there. But to use, for example, our home state of Texas, the Texas Workforce Commission has launched what they call their employee work refusal documentation. Again, you can see that URL here if you want to look that up directly. And jumping to the next slide, we're going to look at a quick screenshot of what that looks like. So on here, you can see this is again, the Texas submission record here, just by way of example. Asks for some basic information, the employer name, your company name, the employer account number. Again, that's going to be your unemployment account number as the employer. If you received uninsurance benefits as an individual, it's not that account number, it's your company one. That would generally be available on most of the correspondence that you received for your company with claimants for unemployment. It would also be on the quarterly unemployment reports that we uploaded to your PPP loan package. So you could find it there if you don't have it in your records, or you can also email your MLW planning team if you're a client, and we have that in our records for you as well. So then you'd fill out some basic information, point of contact, information about the claimant, that would be the employee who turned down the offer, their name, social position that was offered, their hours. Again, this should be all pretty standard information that you would have in your HR records for your payroll, for your internal files there. And then at the bottom, it's going to ask you to select a reason for that refund. And we've screenshotted the options here on the Texas one. And the options here are generally going to be reasons that would be qualifying for an exemption. So the TWC and many workforce commissions have indicated that they will be willing to consider reasons why someone might turn down a job due to concerns primarily surrounding coronavirus. So whether that was that they were at high risk, they were diagnosed with COVID-19, they were quarantined and providing care to someone that had COVID-19, or a number of other reasons, again, being directly affected by COVID-19. You could choose one of those, and it would provide somewhat of an automated way of allowing that claimant, that employee that turned down work, to not just immediately lose benefit, but to be able to represent themselves to the unemployment office. And if it were for a non-COVID reason, you could select that other box and fill in the other. So whether it was just they turned down the job offer, they moved across the state, or they quit for other reasons, certainly you could select other and then fill in that reason there. Now moving on, let's talk about a couple of additional loan forgiveness details here, some miscellaneous details. That loan repayment period is expanded from 2 years, which was pretty short. It created a pretty high payment, so they expanded it out to 5 years. Now again, to reiterate, I do think that the vast majority of you listening tonight should be looking at virtually 100% loan utilization and forgiveness under these new terms. But for some of the outliers, or just for whatever reason, if you do find yourself ending up with a portion of the loan that needs to be repaid, it can now be spread out over 5 years, and that interest rate is still at 1%. So the interest rate is a very low interest rate. The requirement of when you must begin paying on that loan has been extended to a degree. It's either when your bank completes the forgiveness application, when you've submitted all the documentation, which the earlier of when you submit it, or no later than 10 months after the end of that covered period. So 10 months, if your covered period, your 24 weeks ends in October or November, again, it can't end later than December 31st. You would have up to 10 months after that to submit your application, to get all of your information together, and then ultimately, if you needed to, begin paying on that loan. The bottom line is what that means is for many of you, you can wait as late as the summer of 2021 to submit your documentation and still be able to, not owe or not have to make any payments or not have to worry about any calculation like that. Why would you want to? Why would you not just submit it the day after your 24 weeks ended? Well, as we saw in the timeline tonight, this program has been prone to some very herky-jerky changes along the way. And so holding out to make sure we've got final guidance, to make sure that you've got a chance to complete your file as fully as possible, to make sure you've got great documentation in there, you've got everything that you need to have all your I's dotted and your T's crossed, I think is really important here. And so the ability to kind of sit back, let some of these initial applications go through, kind of see what comes out in the news, what responses come out to some of these, and then wait until you're good and ready to get that application through is a really nice window of time to be able to do so. And so don't let it stress you if this is hanging out there a little bit. I think that's a wise path. In fact, most likely everybody would want to wait at least until December 31st of 2020, that extended kind of safe harbor date where you could potentially rehire your employees by to meet that window. So if your window of 24 weeks ends on, let's say, October 15th, you could wait until December 31st before submitting your application, just in case your employee numbers looked better at 12/31. Now, finally, there's a couple of other miscellaneous changes I did want to go over tonight. One is that PPP loan recipients may now have the ability to defer certain payroll taxes through the end of the year. Originally, they had said you did not qualify for this, and the IRS said you qualified, but only until the point that you got forgiveness on your PPP loan, and then you didn't qualify. And now they've come out and said, nope, even if you get a PPP loan, you qualify for this deferral of payroll taxes all the way out until 12/31/2020. Now, those eligible taxes only include the employer's portion of Social Security tax, which is at 6.2% of payroll. So I've gotten some questions out there over the last few weeks, like, hey, Miles, does that mean I don't have to make this? I've got a $5,000 tax payment, 941 payment that's showing due in my payroll system. Does that mean I don't have to pay the $5,000? Unfortunately, it's not quite that lucrative. What it means is that a portion of that $5,000 you do have the ability to defer. But remember, within that $5,000, you've got employee Social Security, employee Medicare, which is not extendable, employer Social Security, that's the one we're talking about, employer Medicare, and federal income tax, both for you as the business owner potentially and for employees. So of that $5,000, only a portion, maybe 20% or something, is attributable to these employer Social Security taxes that can be extended. So it's not quite a break of just skipping out on a $5,000 payment, but maybe at least a few $100s. So should you take advantage of this? Should you not? I think it's up to you. For businesses that are struggling to get back on their feet, that could use as much help as they can get right now to be able to recover as a business, this probably could be one additional tool in the tool belt that would be useful for you. However, you also, if your business is getting back on its feet already, you've got a nice cash balance thanks to the PPP loan and now some new money coming in as your office is reopened and you really feel pretty comfortable, I don't know that this is something you automatically want to do. Again, it's available. However, this is additional scrutiny. It's additional paperwork you're going to have to submit to the government. It does have to be repaid 50% in 2021, another 50% in 2022. So it's not free money or anything like that. So again, I think everybody needs to determine, and you can certainly talk with your planner if you need some insight on how to determine that, whether you could use that additional few $100 of savings per pay period to push that off into the future, or whether you would just like to stay current on your payroll taxes and not worry about that. It's going to be a case-by-case basis in that regard. But if you do want to turn it on, go ahead and notify your MLW planning team if you're a client of ours. And with a few clicks, we can get that set up for you in payroll and get that turned on so you can begin taking advantage. It is retroactive in the second quarter, so it will catch up on all Social Security so far in the quarter and start that reconciling beginning with your Q2 941 filing that's due after June 30th. Second provision I wanted to update on here is that the PPP loan and thinking about how it now integrates with those sick pay credits from that Families First Coronavirus Relief Act. That was the phase 2 relief that came out back in March. Previously, our guidance out there was that you should, if you had an employee who was directly affected by coronavirus, they were quarantining themselves, waiting the results of a COVID-19 test, they had a family member they were caring for, some kind of direct effect on their lives, and they were at home and unable to come into work. Previously, the advice had been, you're in your 8 weeks because those sick pay credits reduce your wage pool for the PPP calculations. Don't use the sick pay credits, save those for later in the year, and instead just continue to use the PPP funds to pay that employee during these 8 weeks so you can maximize the benefit. I do think the logic of that has changed now that we have this amendment to give us more flexibility on when we can spend the PPP loans. And so I really think that advice has now been turned on reverse. If you've got an employee and they have a possible exposure to coronavirus and they are quarantining while they await test results, they have coronavirus and they are staying at home for up to 2 weeks, while they are hopefully recovering from that. If they are directly affected by that, I would recommend you go ahead and utilize those sick pay credits now so that you can maximize those, because now we have the ability to delay the PPP utilization when they come back to work, maybe in late June or July or August, September, whatever the case is. You can still use the PPP money at that point. So I do think it's changed the logic of how that integrates. So if you have someone in that situation, again, if you're a client of ours, reach out. Your MLW planning team can help you turn that on in the system. Please don't just input that on your standard sick pay and assume it can be cleaned up after the fact. There is a special category of wages for these sick pay credits that needs to be activated in your payroll, and we need to turn it on and report those hours in a special way. So it's available. Let us know if you need to turn it on, and we'll make sure you've got that available for that employee. Just a heads up, I have had one client utilize this so far. They did immediately get a reduction of their tax payment that they need to make, and then we filed the form to request that expedited refund of the surplus. And we're now several weeks in and have not heard a peep from the IRS. So this talk that the IRS was going to expedite it and get that money to you quickly, the IRS is very underwater right now for a lot of reasons. They have a lot on their plate, and so that may not be quite as quick as we hoped. It will eventually come to you, but this may be a situation where you have to front some of this money out of your own pocket, and then hope to, in the coming weeks, eventually get a reimbursement. So, and that may get faster as time goes by. Hopefully we will see. But that is an update on the changes to the PPP loan program, and I will kick it back to you now, Jeff.
Thanks, Miles. We do have a few questions that I wanted to go back to you with. I'd like to start by circling back on the discussion on when you want to make the forgiveness application. And you had mentioned that it probably makes the most sense to delay making the, waiting till the end of the year, make sure all of the, there's no changes left to be made, that sort of thing. But somebody brought up an interesting question that said, if I feel like I've used up all my money prior to that, is it possible to potentially, make the application go through at that point? And you might be thinking, what would the benefit be? But I think where they're headed with this is, if I'm concerned about being able to restore my employees, perhaps I am restored currently, but I'm not seeing the benefit of the production coming back like I would hope, and I probably need to start cutting hours or even potentially cutting some staff members to keep things going. If I wait till 12/31, I might not have restored the employees, the way that I did have them restored after, say, 12 weeks as opposed to 24. So what are your thoughts about that as a strategy or a possibility?
Absolutely. So, there's a lot of great questions, and we've heard various iterations of that exact scenario brought up. We've brought many of them up as planners as we've been discussing and analyzing the new rules. What I keep ultimately coming back toward is, like I kind of mentioned before, as the country is reopening, relaxing restrictions and things like that, generally speaking, hopefully most businesses are recovering, are returning to the point where they were before. And so where we stand today, certainly things do generally look optimistic for the future. Now, could there be a second wave coming? Could there be other complicating factors? Absolutely. I think if there's anything we've learned in 2020 so far, it's how difficult it is to project the unknown or to know what to expect. So it's difficult for me to say what could come if we had some additional disaster like that, other than to say that Congress appears to be pretty responsive on this program and may be willing to, modify again the terms of the program based on the future. So if you feel like you've hit 100% forgiveness and want to go ahead and apply, it's a possibility. I don't know if banks will be receiving the application. Certainly they're going to have to refresh the application, things like that. And so you're going to have to weigh the risks of, again, being one of these early applicants. That may be an example of why this wasn't a good idea that we find out after the fact, versus wanting to go ahead and try to lock something in, that sort of thing. And so for me, I err weighing the two on delaying. Certainly there's arguments for both sides. Regarding the FTE credit, again, as I was kind of saying, hopefully our business is more open, more restored. By the fall, I have to believe at some point as a country, as an economy, we're going to get back on track. We're going to get back headed the direction that we were, whether we get this Nike swoosh recovery or what it might be, that we're headed in that direction. And so it's hard for me today to imagine a scenario where we have fewer FTEs in October or December that we don't have one of the exemptions that we qualify for. Because remember, even if your FTEs are lower, that's okay. We have a lot of exemptions now that you would potentially qualify for. So it's hard for me to think of a scenario. There may be some out there where you've lost employees and don't qualify for any of the exemptions that are available right now, that you would receive a reduction. So for me, on balance, I prefer to wait. But I do think everybody's got to weigh some unknown nature to this and decide what feels best to them.
Okay, so on FTE calculation, what about a scenario where you go ahead and you have your people that are rehired, they're offered that position back and they take it, but then potentially choose to quit, say, a couple of weeks in, just not what they were looking to get back into or something like that? Do you see that potentially affecting the FTE calculation? First question. And the second part of that, do you still need to potentially report that to the state unemployment commission, since technically they were rehired, but then chose to quit after that?
Yeah, great questions that we've been thinking through as well. So on the first one, does it affect your FTE calculation? Yes and no. One of the things I did back shortly after May 15th, when that original PPP loan forgiveness application came out, was I sat down and I prepared one of those by hand for one of my clients, just trying to build an understanding of it. It took me about 3.5 hours, and I was not at all confident or ready to submit that to a bank by any means, but I at least had numbers on every line. And one of the things that it did show me is how the FTEs do accumulate. Now that application has probably been outdated and will be updated, and maybe 3.5 hours of my life I'll never get back. I'm grappling with that, but overall, the FTE calculation is a pool of hours. Yes, it's by employee, but other employees can sub in and out. So if you lost an employee and it was someone you needed, your RDA moves across the country and you hire someone else to replace them, you can swap in that person, use their hours, and still hit your same FTE credits. So it's overall, it is calculated per employee, but overall it's an hours pool. What are the total hours that you are running for all your staff through payroll? And then in terms of reporting, if it is someone that has returned to work for you and then terminates, in most states, that means they would have come off of unemployment and need to reapply for unemployment. So in that scenario, you would get another letter like you probably did in March or April when your employees went on unemployment the first time, saying so-and-so has applied, they said they were terminated on this date. How do you respond? And you could fill out that response at that time. So yes, it does need to be reported, but no, it's not quite the same scenario as someone who is already on unemployment, never came back to work for you, and turned down a job offer to work for you.
Okay, and then just a quick clarification on the use with the change from the Flexibility Act. can you still use the loan proceeds 100% on payroll, or do you need to delineate 60% for payroll and 40% for other now?
Yeah, absolutely. You can use 100% for payroll. In fact, I was just speaking with a client this morning, and we discussed when it comes time to submit the application, again, we'll see what the final forgiveness looks like. I don't want to say this is the strategy, but even if they had some rent expenses and some other things over here, if they had, 4 times as much payroll between, May to October as they needed, well, boy, isn't the simplest way to submit the application just to send in your payroll numbers? You send in a couple 941s. It's really easy. The banks would love that because that's a government form they can verify versus some check stub to your landlord or something. So I would say there's actually even a scenario where you may prefer to only submit payroll expenses just for simplicity of documentation.
Excellent. All right, we're going to move on now. As I mentioned earlier, we've got some more serious information to discuss when it comes to the EIDL. After doing some extensive research, what we've discovered is that there's really a lot of loopholes and a lot of rules as far as making sure that you stay compliant with what's required with any of the economic injury disaster loan proceeds. And so we're going to give you a quick presentation on that and answer any questions that you might have there. So I'm going to turn that over to Jason.
How's everybody doing tonight? Good to be back. It's been a little while since we've visited. Luckily, there wasn't too much going on since the last time. Hopefully everybody's having a successful journey back into the business. And from the numbers I've seen, everything seems to look pretty good. At least as good as I would expect coming back from the closure. So excited to see those numbers coming in and looking positive. What I wanted to talk about tonight was the economic injury disaster loan. Not everybody got this loan. It was something that was available early on and people applied for early on prior to PPP. It was kind of the first line that the feds threw to us. This particular loan, I'm going to refer to it so I don't have to keep saying it, the EIDL or a disaster loan. I'm just going to refer to it as a disaster loan, is typically meant for things like hurricanes, regional catastrophic storms, things of that nature. So this was kind of the first time it had been expanded nationwide and used for something like this. So a lot of people applied early on. I created a video for it. It was very difficult to apply for. Everything went silent for a while, and then all of a sudden people started getting emails and approved for these loans. So I wanted to take some time. We've spent so much time going over PPP loans. I wanted to take some time to talk about these disaster loans. They are very particular and want to make sure that everybody listening to this understands how these plans work or these loans work if you got the loan. The first thing that I think is important, now just kind of to make a little, to add a little detail here, if you remember the EIDL grant, the advance, back months ago where you could get up to $10,000 grant, that was related to this loan. So some people that applied ended up getting $1,000 per employee, not to exceed $10,000. That grant was an advance on this loan. And so that's sort of in the same genre here. We're working kind of with the same loan in that case. So that might trigger some thoughts of kind of understanding where that grant applied. It was a little bit confusing on the onset, but that was simply an advance on this loan that people ended up getting. So early on, people got the advance and heard nothing, and then all of a sudden people started getting loan advances and things of that nature. So one thing that I think is very important if you're going to utilize this loan and have gotten this loan is you've got to read your loan documents. I know typically a lot of my clients, they'll just send documents my way and just say, read it, does it look good? This particular one, I do think it makes sense to educate yourself and just read through the documents. It doesn't mean you have to be an expert in it. It shouldn't take long. Just read through it. I want you to kind of understand the tone of the loan terms and kind of where they're coming from, because I think it'll help increase the compliance. One of the things that I think is important with this is we've got to use this loan exactly how it's intended. I do think there could be severe consequences if we don't use it as it's intended. And I think we've got to understand. I had a client that had a friend get one of these loans, and their only recommendation to us was make sure you read every line before you take that loan. And so that's when I'm trying to educate a little bit here tonight. So I think it's very important that you read your own loan documents and kind of understand some of the nuts and bolts of that. Now, this loan, the loan terms are favorable. They are 30-year loan at 3.75%. You get 12 months of deferred payments. And so just from a pure lending perspective, that's fairly favorable in the sense that if it's a 30-year loan, we can sort of stretch that out, and those payments aren't very punitive early on. And so for us that are trying to get back on our feet again, that certainly is not a bad loan. Even when we get the loan, some people get it and say, hey, Jason, should I take this and pay down some other loans? Which is an ineligible use of these funds, but the loan terms are favorable. However, there are strings attached, and so you're going to have to weigh. You're going to kind of have to weigh the pros and cons of favorable loan terms versus having the federal government be a lien holder on your practice. For loans in excess of $25,000, the SBA will take a collateral interest in your practice assets and file a lien on your business. And so now they are like any other lender. And so they're gonna attach themselves to your practice so that in the event that you don't make payments, they could fall in line to foreclose on that practice. And so that's very important to understand. Anything over $25,000, they're going to take collateral and put a lien on your practice. One of the loan terms is that you've got to keep itemized receipts for 3 years. So this is something that we want to be very particular on. We actually went as far as hiring an attorney that had experience in dealing with SBA loans. And one of my questions to him was, is the SBA going to be picky about how these funds are used? And his response was, I can answer that with a resounding yes. So he actually worked for the SBA for 10 years. So we've got to make sure we use this properly and keep those itemized receipts. There is a provision in the loan that says that when feasible, you must buy American-made products. Again, that's all it says. When feasible, you must buy American-made products. So use your best judgment on that. I think there's plenty of ways to use this money other than foreign-made products. If you have, advertising, accounting, interest, there's a lot of things that you don't buy internationally. If there are some, it says just when it's feasible. To me, from a legal perspective, I'm no attorney, but that does leave some room for judgment on that. One of the things that you need to do is when you take this loan, you need to notify the SBA that you got a PPP loan or any other grant related to COVID. So once I take the loan, I need to notify the SBA that I did receive that other PPP. Any other money you received to help you cover losses from COVID need to be reported to the SBA. The two common ones on that are PPP loan and then grants. So some of my clients are getting grants from their county, and that does need to be reported to the SBA. Now, this is an important kind of note here. Can you use, you cannot use the disaster loan and the PPP loan money for the same costs. So where would that come into play? Well, we know the PPP loan money, we use that for payroll costs, rent, utilities, and in the EIDL money, we can't use, while we're exhausting our PPP loan money, we can't use the disaster loan money for that same cost. So we don't want to overlap or double dip that. So during the period of time while you're using your PPP loan money, we would recommend not using your disaster loan money to pay payroll costs, rent, and utilities. I'm going to go through some of the ineligible, or this is the bulk of the ineligible uses of the disaster loan. So we want to make note of this, okay? These are things that you cannot use your disaster loan money for. That would include, while you're using the PPP loan money, all the PPP loan costs, payroll, retirement costs, group health insurance, rent, utilities. Then we kind of get into a list of other things. Shareholder distributions, very important on this. I've had clients say, hey, I didn't take much of a salary over the closures. Can I make a big distribution and pay off some credit card debt? Something like that. We don't want to take any shareholder distributions out of this money. Another thing on here is you can't buy fixed assets. Fixed assets are anything that we buy that costs greater than $2,500 that has a useful life longer than a year. So when I think of fixed assets, I'm thinking of dental chairs, radiography, sensors, things that cost over $2,500 and last over a year. And so you can't use this money to expand and buy equipment and things of that nature. Okay, we can't use this money to refinance other debts. Like I said earlier, you've got favorable terms. Do you want to take that money and refinance debt that's not as favorable? You cannot use this money for that. This money is strictly meant to be operational, required operational expenses needed to get the business to recover. Some of these other expenses here that we've noted, they aren't statutorily limited within the loan provisions, but I think it would be best practice to avoid these types of costs when using the disaster loan proceeds. That's going to be charitable contributions, excessive continuing education. What do I mean by excessive continuing education? Well, if I'm going to go spend $40,000 on a big course, that's probably not a good idea to use this money for that purpose. If it's just normal, standard, I've got to get my CE, I've got to do my staff, minimal dollars, I think that's fine. Things like meals and entertainment, auto, you cannot use this money to relocate your practice, period, the end. So if you're in a relocation situation, you get to be very careful taking this money and spending it. Gifts, any legal fees, life and disability, things of that nature. Again, once you get through using your PPP money, we can pull those payroll, retirement, group health insurance, rent, and utilities costs back in and use the disaster loan for that money. What are our tips and I kind of just went through all this and compiled some tips and recommendations. One important thing is I do recommend you take this money and put it in a separate account. Literally open a separate account, move the exact money over to that account, and you only use that account for eligible costs. Okay. If you're a client of our firms, let us know you got this loan. We can send you a cheat sheet. I just went through the things you can't use it for, but there's a lot of expenses you can use it for. Dental supplies, ortho supplies, lab, accounting, insurance, all kinds of stuff you can use this money for. So I visualize setting up a separate account, getting checks and debit cards for that account, specifically for that account, and having that money directly come out of there. I do not recommend during this time frame using credit cards and commingling that with things that may be ineligible. I really want a perfect audit trail on this money through that account to say, hey, here's my disaster loan money. This is exactly how much I got. Here's everything I used to buy it. You can see it come out of that account. We can prove it in the event you get audited. Very important. Through the PPP money, we didn't necessarily recommend that you separated that money. I didn't think that was overly necessary. For this, I really think it's important. While you're going through this time of recovery and you're using disaster loan money to recover, I think it's a bad idea to take excessive salaries and distributions for yourself during that time. That doesn't mean that you can't get up to what you were normally taking, but during this time, I would try to mitigate those big withdrawals to yourself that are unnormal, that are greater than necessary. Certainly take what you need at home, take what you need to make things work at home, but if you can work through this time period without taking excessive salaries and distributions, I think it will look a lot better. Don't underestimate the provisions of this loan. I've talked about that from the beginning. They're going to be very, very picky about the utilization of this loan. One thing that you need to do is you need to send the SBA by certified mail. If you look in the loan documents, there is an address in there, and you need to send them, and I recommend doing it by certified mail, proof of your property and casualty insurance. That's going to be the insurance, your general business insurance. That's the insurance that covers you in the event of a fire, things like that. You need to send proof of coverage. The SBA is taking collateral in those assets, so they want to make sure they're insured. So you've got to send proof of property and casualty insurance. Again, if you don't have a copy of that, that is your general business insurance, Hartford, Travelers, things of that nature. So we want to make sure we send that over to them. You want to send notice now for our clients. We're going to put together a little letter just letting the SBA know and put them on notice that we received PPP loans and or any grants that we may have received due to COVID. There's also a resolution of board of directors. There is a form, I think it's form 106, SBA form 106. That is this document. There's a little bit that needs to be filled out in there. So for all of our clients, if you'll let us know, and one thing I do want to let you know is let us know if you got this money. We got bombarded with PPP loan emails, all kinds of inquiries. And you may have sent in the midst of all that over and let us know that you got the disaster loan. I'd recommend you redo that now that we've kind of gotten our heads wrapped around these loans. Let us know that you got it, and we can help put this package together so that you can mail that off to the SBA. Like I said, don't use disaster loan money for PPP loan type costs, payroll, rent, and utilities until after those funds have been exhausted. You're going to need to get SBA written consent if you need to. A couple of things that are not permitted inside the loan documents without written consent. You can't sell assets of the practice without written consent. Okay, when would that ever happen? An example of that was, hey, I'm going to upgrade my panel. I'm going to sell my panel to another doctor. If you do that, you've got to get written consent. Anytime you're going to sell any dental equipment, furniture, fixtures, anything like that, you need to get written consent from the SBA. If you're going to bring a partner in, if you're going to sell your practice 100%, let's make sure we get written consent and we're in good communication with the SBA. If you're going to, this is an important one, if you need to borrow money, okay, if you need to borrow, once you take this disaster loan money and let's say you take it and it turns into a loan, you need to be very careful about borrowing more money. The SBA wants to protect their lien hold position. And so you got to be careful about increasing your current loans. So let's say, for example, Bank XYZ loaned you $800,000 3 years ago to buy your practice, and now you owe them $650,000. Let's say you want to expand. Well, obviously you need to borrow money to do that. So you go back to Bank XYZ to increase your loan. That is not permitted by the SBA loan documents. You've got to get written consent to increase your loan balances because, again, they're trying to protect themselves from you not being able to pay them back. So anytime we got to borrow money, I highly recommend getting SBA written consent. Again, one of the things in the loan documents, you cannot reload. You cannot use this money to relocate your practice. So if you've got to relocate and you need to keep this loan alive, you need to get written consent from the SBA if you want to relocate. Basic issue there. When in doubt, get SBA written consent. Do not use this money to refinance less favorable debt. And while the terms are favorable, I recommend working on a plan to accelerate the pay down of this debt as your business recovers and COVID-19 concerns have cleared. Let's come up with a plan. Although it's favorable, let's come up with a plan to get the government, out of our hair to, in simple terms. Let's get them, let's clear those liens and get them off our back. That they are not good business partners. I think there's one more, Jason. Okay, yeah. I did put together a more thorough video related to this loan, and you can find that at our website, mlwfinancial.com. There's a COVID-19 resources page there. You can go there. It's going to dive in a little more deep. Any clients that I had that got the loan, I'm going to require you to go watch that. It's very, very important to educate yourself. And you can go to YouTube and subscribe to our YouTube channel as well. So that's all I have for you in regards to the disaster loan. Hopefully that was helpful.
Awesome, Jason. Thank you. And now we're going to go to our final portion of our webinar this evening, which is going to be involving the proposed new HEROES Act, which is still being considered by Congress. And so I'm going to send that over to Michael.
Good evening. Thanks for joining us this evening. Hope this finds everybody doing well. While it still is has not been passed by the Senate yet, we did want to highlight some of the points regarding the HEROES Act that you've probably heard about in the news here over the past couple of weeks. So the House did pass the HEROES Act mid-May. That's going to be a $3+ trillion response to the current pandemic. The bill's passage in its current form is unclear and not likely to pass the Republican-controlled Senate at this time. I think they're scheduled to vote on that this month. Senate leaders have raised concerns with some of the items in the bill, and also have, in addition to that, I think are wanting to take a wait-and-see approach on how some of these other stimulus measures pan out before releasing additional funds. Just to give you a point of comparison relative to the CARES Act that did pass, this HEROES Act is quite vast, spanning over 1,800 pages in length. The CARES Act was only, I say only, was only 880 pages. From a dollar amount standpoint also, with the HEROES Act being $3 trillion, the CARES Act was $2 trillion. So significantly more information in there in length and amount as well. This act takes a wider net in stimulus measures or potential stimulus measures, focusing on many different business and personal relief measures. We wanted to drill down on some of the provisions that will most likely affect you or potentially benefit you, and then kind of give you a glimpse of the other measures in there as well, just to kind of give you some perspective on what that looks like. So one of the things that you may have remembered from the CARES Act, or may have remembered hearing about either in the news or even on one of our webinars also. So in the CARES Act, there was included in there an employee retention tax credit, where if a business was fully or partially suspended due to a government order, or had sustained a significant decline in gross receipts, so that would be a 50% decline in gross receipts relative to the same quarter in the prior year, there was a credit of 50% of qualified wages up to $10,000 per employee. And that credit was available as long as the business stayed at that 50% reduction relative to the same quarter of the prior year until the business was over 80% in a look back from the prior quarter. So with the HEROES Act, that would potentially expand the employee retention tax credit to 80% from 50%, and also up the wage limit to $45,000 per employee or $15,000 per quarter per employee. It would instead of it just being the 50% cliff, it would also include a partial credit phased in for employers who suffered a partial decline in gross receipts from 10% to 50% versus that 50% cliff. It also would adjust that 80% threshold on the back end from 80% up to 90% to make it a little bit harder to get over that threshold or allow you to take that ERTC a little bit longer. Now, one of the provisions in the CARES Act is if you did get PPP funds, you couldn't also take the employee retention tax credit. In the HEROES Act, they are expanding that so that if you did get PPP funds, you could also get the ERTC as well. Now, the tax credit couldn't be taken on the same payroll cost that you were using for the PPP, but assuming that you did experience a decline past your coverage period, this could potentially be a benefit where you could take both if the business did continue to lag, especially with the phased in or partial credit from 10% to 50%. The paid sick and family leave would be extended from the end of this year through the end of 2021. So assuming that the pandemic continues into next year and employees needed to miss work based on the different stipulations with the paid sick and family leave, you could get the credit for paying them wages based on the certain criteria that we had reviewed in other webinars as well. There could also be a payroll tax credit, or there's a proposed payroll tax credit that's equal to 50% of qualified fixed expenses. Now, the language here is a bit confusing, but it's the lesser of the same quarterly expenses for 2019, $50,000 or the greater of 25% of wages, or 6.25% of the gross receipts from last year. Now, what these fixed expenses are, it's essentially the non-payroll cost covered under the PPP loan. So this would be rent, utilities, telephone. So the easiest way to think through this is the non-PPP forgivable expenses, non-payroll forgivable expenses included in that program. The business operations must be fully or partially suspended during the calendar quarter due to government orders or a significant decline in gross receipts. Now, the one caveat here is on this credit for certain fixed expenses, this would have to be reduced by the ERTC or the paid sick and family leave credits. So this would get netted against those if you were already taking advantage of those other credits as well. Now, to hit some of the highlights on some of the other provisions in there, and again, this is to give you guys just kind of broad strokes of what's in the bill, just so that you know just so you know what's being discussed and what's out there. One of the things that's in there is the recovery rebate. So this would provide a rebate payment similar to what was in the CARES Act. It would be $1,200 per taxpayer, $2,400 for joint filers, and $1,200 for dependents. The maximum household payment would be capped at $6,000. Now, this is one of the hotly debated items where the Senate has said, we are not going to be okay with sending out additional rebate payments. This appears to be one of the lines in the sand that may be out there. Who knows? We'll see what's debated this month as it does potentially go to the Senate. State and local tax deduction. So this would be a temporary repeal on state and local tax deductions on your personal tax returns, Schedule A for 2020 and 2021. This is currently capped at $10,000 per year. So a little bit more flexibility on what you're able to deduct on sales and local tax deductions on your personal tax returns. Increase in the child tax credit, currently $2,000 per eligible child, increased to $3,000 per child for tax year 2020. And some more items, one more item on the personal tax return, an increase in the dependent care tax credit, increased from $6,000 to $12,000. Income phase out still exists. One of the things that's been hotly debated is the expansion of the federal employment benefits or federal unemployment benefits or the supercharged unemployment. As it currently stands, the extra $600 per week supercharged benefit is set to phase out in July of this year. That would be extended potentially to the end of December. Again, is one of the things that is in there in the House version. This is one of those items that is being hotly debated that most likely will not make it into the final legislation, but is in its current form. And then student debt relief, extending forbearance for student borrowers through September 2020, applying that to private borrowers as well. For any of you that have refinanced your student loans with private lenders, you've not been able to take advantage of the forbearance that has been on federal loans. The other thing that's in there is up to $10,000 in debt relief for federal and private student loan borrowers. Now, in the initial bill, this was kind of a carte blanche $10,000 benefit. One of the things that's been debated lately or modified even by the House is they may try and narrow the scope of that to high-risk borrowers or borrowers that have had a hard time making their payments, that have fallen 90 days behind on payments, have a $0 payment on the income-based repayment plan. So I wouldn't, if that does stay in there, I wouldn't necessarily expect that to be across the board. I think they may limit that to high-risk borrowers that they deem may really need that help. Some other high points on the provisions, and this really kind of just gives some dollar amounts to kind of the scope and the expanse of what's in here beyond the provisions for small business owners. It would be an additional $10 billion for the EIDL loans that we've talked about earlier tonight. $75 billion in housing assistance, $200 billion for hazard pay for frontline workers, $30 billion for airlines and contractors, additional state and local government relief funds. A couple of the high points on what was excluded in this bill, potentially for what you guys do. The Act is currently silent on provisions for liability protections for businesses that reopened during the pandemic. That was something that I know has been lobbied as far as some businesses that had to reopen sooner rather than later, especially in the healthcare industry as well, as far as trying to get liability protections for businesses that are reopening. And then also it's silent on how the treatment of business interruption claims will be handled due to COVID-19 related events. We've seen emails from clients on business interruption insurance policies that are not paying out based on pandemic, which is usually an exclusion in these policies. I know this is something that has been lobbied and debated, and we've even seen some discussion on class action lawsuits. That has been left out of this act as well. All right, I think that is all I had as far as kind of broad strokes. And again, this is just to kind of give you guys some framework on what's out there in the current form. If you've seen this HEROES Act talked about in the news, again, we don't think it's likely to get passed in its current format, but just wanted to make you aware of some of the provisions that would potentially impact you, and then kind of just give you an idea of the scope of this bill.
Awesome, thanks, Michael. That was a lot of information to try to cover, so appreciate you trying to get through that. And obviously for everybody, clients and anyone else that's watching this, we'll do our best to try to provide you additional information as that becomes available on the ongoing changes that may be coming from that fourth stimulus package. So stay tuned for that. We're gonna pretty much wrap up here this evening. I've got just a couple of questions left I'm gonna throw out that we've gotten throughout. Jason, I'm gonna go to you first. Do any of the provisions that you discussed regarding the economic injury disaster loan, do any of those apply to just grant money that you might have received if you didn't receive the whole loan?
Yeah, that's a good question. So like I said, just to kind of reiterate, early on we applied for these disaster loans, and a lot of people that ended up getting the loans got the grant, and that was $1,000 per person, not to exceed $10,000. That doesn't have any real regulations on it. I think if you get that money, it's a grant. It's yours to keep. You don't have to pay it back. It is a legitimate grant. So you get to keep that money. Now, so I don't think there's anything special you need to do with that. Now, the one interplay that we have here between the grant and the PPP loan is that you do need to, and this is very important, you do need to notify your banker that you received that grant. On the PPP loan side, one of the provisions of the PPP loan is that your total forgiveness must be reduced by the amount of grant you got. So if you borrowed $100,000, you got a $10,000 grant on the disaster loan, you could only get $90,000 forgiven. Just to make that simple, they don't want you to have any more forgiven than what you got in PPP loan. So if you got the $10,000 grant that you don't have to pay back and $90,000 forgiven on your PPP loan, that's a total of $100,000 you don't have to pay back. And so that's kind of how and that's what your PPP loan was. And so you've got to notify your banker that you got that loan, because it's going to get cross-referenced when you go to get for forgiveness. And if it's not, I don't want you to get caught trying to pull a quick one on the SBA. And so we definitely need to notify the banker. That's the only thing we need to do with the grant, is we need to notify the banker that you received that grant.
Okay. And then final question on PPP loan forgiveness. Miles, I'm going to go to you with this. There's some information out there that's suggesting that applications may not be required for loan forgiveness on loans of maybe a certain amount. Like there might be a threshold where they're just going to say, this now is grant money, it's not worth our trouble, that sort of thing. Is there anything to that?
Boy, I sure hope so. That would just really make my year if it proves to be true. I don't need anything else for Christmas but that. Yeah, I think every accountant is really hoping for that. I have not seen anything that was beyond sort of idle speculation and chatter from certain members of Congress and things like that. Sometimes that smoke, indicates a fire, and sometimes it's been, wildly incorrect. So I've not seen anything concrete. It certainly makes sense. The introduction of the safe harbor for being economically affected that they had, and they set that threshold as high as 2 million. If you were under 2 million, you didn't have to have a separate certification of being economically affected. The winds do seem to be blowing that way to an extent, but until we see something more official, I would not yet hang my hat on that.
Okay, very good. All right, well, as we wrap up this evening, we want to remind you that we will continue to gather and review information as it becomes available, and we'll provide those updates as soon as possible. Also, for those of you that did receive that EIDL, let me again remind you to check out the very informative video on the proper use of the idle funds, which can be found on our website at mlwfinancial.com/COVID-19. And the recording of this webinar will also be uploaded to our website once it's processed. You can find it there or via social media. Follow us on Facebook or Twitter for ongoing notifications and updates. Thanks to our panelists, Jason, Michael, and Miles, and to everyone who helped with research and preparation for this evening's webinar. We look forward to continuing to serve the clients in our MLW family throughout the COVID-19 crisis and hopefully into a more prosperous finish to 2020. Thanks again and good night.
Thank you.